So I have a question for Devon, and this was about the section on tax bracketology. How does this impact potential Medicare surcharges? How does the tax bracketology impact that?
Yeah, so I think just using the example, just using that case study example, if you're an individual in your retirement, between your Social Security and your investment income, for example, is over, let's say it's 97,000, an example we use, and we take advantage of a lot of these different strategies, and you reduce your taxable income from 97 to 80 to 84, right? Now you're under that first level 1 Medicare surcharge, and you can save yourself a couple $1,000s in premium. So that's what the idea is. Like, we're going to plan out over the next few years to kind of keep that income, pretty level. There'll be times when it will go up, and it's just, part of life and inflation and things like that. But the idea is to keep it as level as we possibly can. So, as there's inflation riders on what those levels are, that you can, proactively, stay under them.
And Devon, another great topic that we didn't even have a chance to talk about today was, capital gains. And if you're in the 12% tax bracket, 12% tax bracket with early retirement, it might be before RMDs kicked in. You don't have to pay capital gains tax. So it's a strategy how we take care of your assets, but distribute your assets.
True.
All right, so we have a few more questions coming in. If anyone else has any questions, feel free to just click the little Q&A icon down at the bottom, and then we'll see it. So what is the procedure to convert from IRA to Roth? What is involved?
First thing you can talk about is talk with your planner and seeing if it's a good idea for you, depending on your tax bracket and where you are. But it's a very simple procedure. The planner and your customer service relationship can help you with, customer service manager here at Ribby can help you with that. And it's basically taking a distribution from your IRA and open up an IRA, a Roth IRA if you don't have one, if you have one already, and just journaling the money over. So it's a simple process, but again, you have to go through it with your planner and make sure it's a good opportunity, it's the right opportunity for you.
How does tax loss harvesting affect income from my accounts?
That's a great question. I think we covered a little bit that, basically as we define income at Ribby Advisors, it's capital gains, interest, and dividends. So by doing the tax loss harvesting, we can create the portion of your income that comes from capital gains every year. We can make that either decrease the taxes on that or make those taxes zero. And not just for this year, but again, they carry forward. So that big volatility we had in early March and April, we were able to take advantage of that and create losses, not just for this year, but sometimes losses for the next couple of years. So it can really reduce the amount of capital gains tax you pay by doing that. Again, those are for the non-qualified assets. The tax deferred and Roth IRAs are already tax deferred, so capital gains doesn't count for taxes in those two accounts.
Does the CARES Act impact my tax situation?
Yeah, I would say, I think we talked about, a bit with the RMD situation and RMDs being suspended. So, I think that's good for folks that don't want to take their RMDs, and, it keeps the income down a bit this year. But I think also, and, I mentioned this, we talked about this before, but the CARES Act cost us, a lot of money. And I think the new way we think about recessions, the government does, I think after 2008, the playbook was spending our way out of recessions, keeping the economy stimulated that way. And, I think we're coming into this year with a $1 trillion deficit without thinking that we were going to spend another $2.5 trillion just to keep us from, falling into, a really, really, really bad situation. So I would say it's not a bad guess to think that we're going to have to make that up somewhere. So if tax rates are a little bit higher in the future, it wouldn't be surprising at all, in my opinion.
Are there any tax savings opportunities available pertaining to education costs, such as college and private schools?
Great question. The 529 plan is always a great way to contribute for college savings, even for children and grandchildren. That's still our primary source or recommendation. And the being is that the money you put in there, you can get a small tax deduction from the state, for most states that you live in. Not every state gives you a tax deduction, but a lot of states do. And you don't get a federal tax credit deduction, but you get the state one. But the money stays in there, and say you have a child or a grandchild that's a baby, it can stay in that account for 18 years and grow tax deferred and come out tax free if it's used for secondary education. The law of 2018, the Tax and Jobs Cut, actually made it so you can use $10,000 a year for free college education, private schools, K through 12. So that's an advantage. The other thing I would say is if you have a Roth IRA, you can use Roth for educational purposes also. So that's, there's not a straight out deduction for colleges, but there's ways to take advantage of the vehicles out there that you can look at.
Okay. And we have, I think we're going to answer one more question. Before I get to that question, I just want to remind everyone, I closed the polling on whether or not to get the tax minimization assessment. But just keep in mind, the offer is open and stands. So, either send us a message in the chat whether you'd like it, or of course, just feel free to always reach out to your financial planner or one of the customer service managers. This question is about a Roth conversion, and how do I decide if it's worth it to pay the taxes now and reduce my account size, or let the higher amount grow and pay the taxes later?
I think that I know, Patrick, I know you went through it during the presentation, but I think a couple of things. You want to look at time. The big thing about the conversion is looking at how far along like, is that money going to be able to grow? You also want to look at where you are from a tax bracket perspective. So especially this year, there are a lot of folks that may have been laid off, not taking RMDs, like we mentioned. Maybe a great year to say, what, I'm going to do a Roth conversion, this year. So I think there's a lot of different components, and it has to fit in your plan and make sense, right? And Patrick, I think you probably agree a bit, or do you have anything?
No, absolutely, Devon. I think it's per plan, and it's a great opportunity to sit down with your planner and discuss it to see if it makes sense for you. Again, taxes are cheap right now. It might not seem like that with July 15th coming up, but we are in a lower tax environment right now. So it might make sense, depending on how much you need to take out of your IRA right now to live your lifestyle, and what's the goal of that money. We have some clients that aren't using a lot of their IRA, and they want to leave it as a legacy. So taking part of that IRA every year and converting it into a Roth might make sense. We have other clients that say, you know what, I worked hard and I'm going to live my lifestyle. Whatever left over is left over. And they're using the money, they're using the RMD to live their lifestyle. So it might not be an opportunity for them. So it's a good opportunity to sit down with your plan and see how it makes sense for you.